guys agree with me, there's a theory that eventually, maybe not this government, but eventually future governments, because the debt will be so much of the student populations, and these guys obviously paying it off every month through the salary post certain thresholds, the government will have to write that debt off.
The theme at the moment is AI, and the potential AI can bring to those 7 stocks, but also the global economy. Are those 7 stocks overvalued?
What did you study, Mohammed?
I studied a Mickey Mouse degree. No, to be fair, it's not a Mickey Mouse degree. Well, I don't think it was. I don't think it was a Mickey Mouse degree. I majored in psychology, and I minored in sociology. Okay, so that was my first degree.
In London?
Yep. And I then did my postgraduate in Islamic studies with a specialism in law and theology. But I also studied comparative religion from priests, from scholars of Hinduism and Buddhism, different sects of Christianity as well, and others. So I have a phenomenal respect for world faith.
Now you're independent.
I'm coming on to that. Okay, so I'm not a really good person to actually look at in terms of identifying a career path, right? Because I don't know what I'm going to be doing in 10, 15, 20 years time. Okay, and I have a quest of continuing to learn. Whatever it may be. I have that passion that just wants to learn, just absorb as much as I can. But I actually love finance. I love investments. And I've specialized in this particular space for 15 years now. But I specialize not only in the investment side and the financial planning side, but also on the legal side as well. Because I recognized many years ago, it's probably coming up to around 15 years ago now, that the private client world is actually coalescing with multiple disciplines, and you need a new type of advisor who can actually challenge or solve a whole host of new age problems that you wouldn't have in the past. So most people would go to their private bank at Coutts or somewhere similar, and their private banker would put them in touch with someone like you, Saftar, okay, or someone like Prajesh to give the financial planning, and then to come to you to give the investment advice, and then go to a legal professional to give advice around trust funds, and all 3 of you are speaking to one another, with the accountant who's getting confused. Okay,
of course.
But it's stuff like that. So then that I recognize that, all right, look, I need to at least be an expert in 2 of these fields, and that's the trajectory I've actually been taking.
I'm just aware of time. I want to get our head stuck into the tumbleweeds of the investment world and investment space. I'll start off with the tech stocks. I was just looking up that the magnificent 7 stocks, combined market cap of $17.5 trillion US dollars. Trillion, that's 12 zeros. So it's a huge market cap compared to the entire stock market. What that means for people that invest is if they're investing in a US equity fund or the S&P 500, they'll have a significant exposure to just those 7 stocks. Even if they go to a global scale and they diversify globally in accordance with what we advise, they'll still have around between 10-15% exposure if the fund is market weighted to those 7 stocks. Now, those 7 stocks are very valuable because, for a number of reasons, but the one main theme at the moment is AI and the potential AI can bring to those 7 stocks, but also the global economy. Are those 7 stocks overvalued at the moment?
So who knows? But what I would say is this, and I'll answer your question in a minute. So you got 7 stocks or 10 stocks. You can play about the numbers. As you say, $1 trillion valuations, massive global giants. For example, the UK economy overall, all output is to say about 2 trillion, 2.5 trillion or whatever. So think about that. Every single person in the UK, all output is relative to one company in the US, whether it's Nvidia, Alphabet, or Tesla or whatever. What I would say is this. The market is the market, okay? I've been through the dot-com bubble, which we had a massive spike up in share prices during 1999 and 00, and then a massive crash thereafter. I do not think this is similar to the dot-com bubble or that era, and some people make that comparison. And the reason being, many of these companies that you referred to, Prajesh, have got incredible profits, incredible buying power, and really, really strong market share, whether it's in the US or elsewhere. I was in the US last year for some family visits, and I saw some of that at first hand in San Francisco and elsewhere. They've got robo taxis now. That's going to be rolled out in the US. I'm sure in London they'll be here in a couple of years' time, amongst other things. So I think Bill Gates said it really nicely, that most people, in terms of technology advancement and technology per se, most people overestimate the short term of technology, but underestimate the long term opportunities, advancement, or scalability of technology. And I think that could be happening here, where short term, clearly we saw a sell-off in some tech names during Feb and March of this year as geopolitics, Trump, tariff announcements, they've gone up a long way. You can argue they're overvalued relative to their financial ratios that people look at ordinarily. But then you can also argue that because of the prospects of technology, it's taking up all of our lives. And it's continuing to do that, whether it's through your iPads, now AI enabled, your phones, and whatever else going forward. And even myself using some AI in terms of some of my work. That took me maybe one day 6 months ago. It's taking me 20 minutes to do now, where it's writing up essays and getting it all tidied up and cleaned up in terms of grammar or whatever. So that's productivity for you. And so I think there's underestimation there as well. So I'm not convinced they are overvalued. But that's not to say that it'll be the same 7 stocks that'll do well in that cluster for your clients or some clients. They may move around. Some might drop out, become less valuable. But some other stocks may come through. Oracle has had recent rises for the past few weeks because of data centers and contracts there as well. We get some new companies coming through as well that are even private still. You mentioned, Mohammed, you went viral on TikTok. You're a TikTok superstar, from what I can see. TikTok is owned by ByteDance. ByteDance is a private company in China, $100 billion plus company. As you know, Trump's been trying to change it around or whatever. So let's see what happens there in terms of how it structures. But there's remaining private for longer as well. And so they have significant market shares. It's very hard to penetrate that. We're really seeing that with OpenAI and ChatGPT or stuff. So I'm, as a business at Binary Capital, very much positive, or as they say in the industry, bullish on technology long term. This year, next year, we might have wobbles, volatility, a correction. But as a long-term investor, and your clients should be long-term investors as well, taking a 10, 20-year view on things, I think they certainly should be in technology anyway. Nobody has convinced me what other sectors are better than technology to outperform or create significant returns, whether it's 10% a year, 20% a year, in a diversified manner.
I think sectorial distribution is fine here with a focus on technology stock. I think what Prajesh was referring to was the 7 specific stocks. So if we were just investing in those 7 specific stock, could we see much growth in those 7 stock as opposed to moving into investing into smaller companies who are within that sector?
I think, those 7 are highly valued. They are strongly valued. So there is a risk to invest purely in that cluster. Hence the reason where you guys come in, have a diversified portfolio, diversified geographically, diversified in themes. We ourselves also like healthcare as a theme, for example. Biotechnology is going to be a massive theme as technology, healthcare comes together. We're all touched with living longer. Every government's got budget pressures, healthcare pressures, and so one way of managing that is through technology, whether it's through the British NHS, the US system, Europe, whatever. So I think that's an interesting theme as well. So one should be diversified, but my view is you should still have a bias to, or certainly a decent allocation to technology, whatever way you want that. maybe not to the top 7 per se, but it's hard to avoid if you're taking where you're buying an index or a basket.
Oh no, of course.
Or even a fund itself. Because our industry is, again, a bit weird as well. Because if you don't own them, you're going to underperform. Nobody's going to give you capital. So often you don't get any fees, or you get less fees. So it becomes quite a virtuous and a virtuous circle as well for many clients or many in our industry, where they have to be invested to maintain a levels of performance relative to, because we get measured often by our competitors. If he's doing X, why are you not invested in X as well if he's doing well? And so on. So there's a lot of peer pressure. Again, you have to avoid that. Going back to what I said right at the start, following your own pathway, but you've got to just manage some of those psychological effects as well.
Yeah, nice. How do you think youth should get into investing, Saftar?
I think a lot of them are doing that now. It's kind of pleasing to see them, whether it's through social media, TikTok, Instagram. Obviously the rise of crypto, Bitcoin is interesting, but it's also got flaws. People can lose a lot of money. There's a lot of bad behaviours in those kind of areas. I think what people should do, young people should do, is, as I said earlier, in terms of first principles, start reading, analysing economies, politics, trying to understand the world around them. Once you start understanding the world around you, you can then say, hang on a minute, what's interesting in Europe, whether it's this sector or that sector, how can I invest? How can I dabble in some investments? And as you know, nowadays it's so easier through an app on your phone to invest. When I was doing it, I literally had to take pound notes to the stock exchange, give them the money, sign a piece of paper, get a certificate, which I had to keep safe in my house. Otherwise, if I lost that certificate, I didn't have the shares anymore. But now it's so much easier.
Bearer shares.
Sorry?
Like the old bearer shares, isn't it? The bearer certificates, isn't it? As they were called.
Yeah, exactly.
You'd actually need the physical.
You need the
piece of
physical
paper.
certificate, because then you could because it was on that, your name was on that certificate. They typed up your name, and then when you wanted to sell it, you went and give them the certificate, and then they signed the document to sell. So obviously now it's so much easier, cheaper as well. To buy a share or buy a fractional share. You could buy it on Revolut or some of these important, money apps as well to do so. So there's much more democratization of finance. So I think young people are already getting into that. I hear that all the time. Look, I'm looking at this trade or looking at this investment as well. But it goes back to the point of being educated. Look at first principles, read books, read Securities Analysis by Benjamin Graham. Read the original version in the 1920s, because that's what's going to educate you about finance and how to value a company.
Which book was that?
Benjamin Graham, Securities Analysis. It's a book that Warren Buffett read, or he was the pupil when Benjamin Graham was teaching securities analysis way back 100 years ago now, roughly.
Saftar, could you give us an overview on active investing, passive investing, and smart beta?
Yeah. So in simple terms, is passive investing is where you buy the haystack. You buy the whole haystack. There's 100 companies in the UK, FTSE 100. You buy them all. So basically, the FTSE 100 goes up in value by 10%. Say, for example, this year, you get a 10% return, minus some fees, but roughly 10%. Okay. So you're buying the whole haystack in an analogy. Active is where you're saying to yourself or to clients, look, I know I'm really good at research. I'm really good at finding the best companies out of that 100 list in the FTSE 100, and I'm going to choose the top 20. So I'm not going to just buy the haystack. I'm going to buy the needles in that haystack. And then I'm going to use that to hopefully create a return for you, client, that's better than that index, or better than competitors. So that's more active investing. You're taking an active position in a stock or positions and putting all your bets onto various. You still might be diversified, but not 100. You're taking, and it's more expensive to do. Costs are higher, and actually it takes more time to do that. Analysing companies, meeting management, travelling to see them, and so on. So typically fees are higher as well there. While passive, you can do a lot with computers now. You can do a lot through trading, through algorithms and computers, so you need less manpower to do that. Hence a lot of this passive investment houses, in fact not far from here, where we're speaking from, I've got trillions of dollars of assets as well, scale really, really well. And then smart beta is a kind of halfway house, where you're taking a position that's maybe linked to an index or linked to a basket of stocks or positions, but you can weight that. You can weight that based on maybe dividends. You can weight that on profitability. You can weight that according to different sectors as well. So you're taking a kind of slightly nuanced, active position, but in a rules-based approach. Okay.
Yep.
So therefore, costs can be kept low, because one key rule of investing that somebody should take away is look at your costs. If you can manage your costs and make that money work harder for you, you should be doing okay with your investments. So always look at the cost base. I'm sure you tell your clients that as well fairly consistently. So smart beta is a kind of halfway house between that. Lower cost potentially than active, and taking a kind of more active rules-based approach. We're going to buy all these companies that have got a dividend yield or income above 3%, for example, or we're going to buy all the healthcare stocks that are lowly valued in the US, for example, as well.
Nice, thank you for that.
I wanted to wrap up this podcast with a couple of questions for the youth. So, what were some of the mistakes that you made when you started out in investing at your young age that you could highlight, and the lessons you learned that we could impart on?
I think, as an investor, as a human being or as an investor, we all make mistakes. Mistakes are part of life. They're part of investing as well. I think the key thing is to learn from them and don't do them again. So I've made many mistakes where it's buying stocks that I've got excited about. Technology as an example, during the dot-com. Certainly whoever's around then got caught up in that frenzy. Let's buy this stock, it's going to IPO, it's going to list, it looks really exciting, and then you bought some of that, and then it went to zero, basically. So you lost money, going, what the hell, what have I just done here? So that's lessons in terms of learn from your mistakes, and also investing in some respects is not rocket science. Patterns repeat. So learn from the best investors, hence going back to a point about reading. Learn from what other really good investors have done and follow them, whether it's mimicking them or thinking about how they've done it and how you can adapt to their style of investing as well. I think that's very important as well. So plenty of mistakes in investing, even in a career.
Can you share, sorry Saftar, can you share how much money was the most money you lost? Don't be shy.
I've lost a lot of money. 30,000, 50,000 plus on shares that I shouldn't have lost because I was too greedy or got carried away, for example, and you got euphoric on this investment or that investment as well, as one does, and they've not done so well throughout time as well. So again, that's an interesting lesson, because you want to manage that loss psychologically. Don't get upset, don't get stressed by it, don't get depressed by it, and dust yourself off and move on and have maybe learn from it, and therefore you can make that return back. It might take you longer to do so, but you make that back in, say, the next 12 months, 18 months or whatever, or more so as well in that respect.
Gold is really popular right now.
Okay.
I mean, there's loads of videos in people investing in gold, advocating the investments in gold. What do you think about gold within a portfolio?
I think gold is an interesting asset. Clearly, it's a physical metal, and it's got no real value unless somebody's prepared to pay for it and buy it from you. Because it doesn't give you a yield or anything like that. It's just there. People have it for jewelry or whatever, clearly, so that's interesting as well. So gold has done really well over the last kind of 20 years. Interestingly, for your listeners and viewers, the bottom of the gold price was pretty much close to when our Chancellor in the late 90s sold a lot of the UK gold.
Okay.
The Bank of England is not far from here, as you guys know. In the Bank of England, there's a massive vault where they stole gold, the British gold as well as other gold, I think. And Gordon Brown, when he was Chancellor, sadly, somebody said, look, you need to sell the gold. We can use this money for whatever else. And that was when about $200 an ounce or $300. It was a really low price. And as you know, gold has gone up a lot since then, 10 times or whatever. So that was a big mistake by the UK government. But aside from that, I think gold is an interesting asset class based on the trends about monetary policy, printing of money, inflation. There's limited supply of it globally. So if you have it in times of war or famine need, especially now where this geopolitics is so varied. We've got so many kind of mini wars, or kind of World War III has always popped up in headlines. You've got political dialogue that's quite weird sometimes as well, where it's from here in the UK, the US, and so on as well. So it's seen as a kind of safe haven asset, and I get why people will hold it in portfolios. We in our strategies, we've kind of held. We used to hold gold. We kind of held off purely on valuation grounds because it's gone up so much as an asset. Do we feel it's going to maybe drop down again? Is it a leg down? We don't want to get caught in a kind of bubble or euphoric rise as well. But I get why people hold it, and I get why people would want to hold it when it's physically as part of jewellery or an asset, or even now through paper. You can do that.
I think it's a mistake that people think that gold only goes up.
Yeah.
Because if you were to look at the FTSE or the S&P, that only goes up.
Sure.
Okay. But when it comes to gold, you've still got incredible amounts of volatility within it, and I think that is what is amiss with, dare I say, amateur investors or investors who are not as experienced. Whereas gold shouldn't necessarily be looked at, in my opinion, correct me if I'm wrong, okay, as an asset class that should control volatility. Okay, you should really be looking at short-dated bonds for controlling volatility. Any comments?
Yeah, I would agree with that. Maybe in a diversified portfolio where it's gold or precious metals per se, silver, palladium is another one that people use sometimes. Where it's short-dated bonds, you may use that in client portfolios. What we prefer to do is have some short-dated or medium-dated bonds, but also liquid alternatives are a really interesting asset class or product class where you can get daily liquid, low fees, touching on earlier, access to some interesting markets based on computers and algorithms, trading long equities, short commodities, long bonds, whatever, whether it's from the US or Europe and so on. So you get that smooth return of capital growth without that vol that you would see even in fixed income. Because remember, fixed income, short dated I get, but fixed income bonds can be quite volatile based around inflation, interest rate expectations, and whatever.
So your liquid alternatives that you've mentioned here, is that effectively like a hedge fund?
Not really hedge funds. It's more like some are quant funds. A quant fund is like a fund that's traded through computer algorithms, quantitatively traded, as they say in the jargon. Or we also have a normal investment fund, but the fund manager or the team are managing different assets within that, and they have a mandate to create a return of, say, inflation plus 5%, or inflation plus 6% or whatever. So quite smooth, return profiles. So we like them, and we like them not as a 5% allocation, often as 20% allocation, so quite chunky allocations to portfolios. So maybe say 50% equities in a balanced portfolio. 2 years ago, maybe it was 60% equities, 40% fixed income. We think that world has changed, and clients need to understand that. So maybe 50% equities, 20 to 30% liquid alternatives. I just touched on examples there, and maybe 20% or the remainder in short-dated and medium-dated corporate or government bonds. So having a kind of free pillar or free asset class approach to investing for clients in their portfolio. So you have a more diversified, more nuanced, more, shall I say, sophisticated way of investing. So you minimize the downside, and hopefully your equity portfolio will do well when markets go up, as should your liquid alternatives. And your fixed income just there steady, protecting capital as well.
Fantastic.
Guys, I'd love to continue.
I've got a lot more to talk about.
This podcast.
I've got a lot more to talk about.
We haven't covered everything on the advanced report, but before we finish up, any final comments?
I wanted to go into macroeconomics, right? How long have we got? I'm bringing in the videographers, by the way. We are way over time.
We're over time. We've been talking too much.
We've been talking way too much, guys. So we are going to end it. We're going to have Saftar on again probably another time. So brilliant. Thank you so much, Saftar.
Pleasure, as I said at the start, pleasure for having me. It's been good fun.
Brilliant.
Learning about your businesses, your questions have been really insightful as well. I look forward to part 2, maybe.
Oh, brilliant.
Yes,
brilliant. All right, superb.
Great.
Thanks a lot,
Thank
guys.
you for listening.